All right, volatility is back. Well, did it ever really go anywhere? I don't know. Why? Well, it's because the marketies are literally having to perform a colonoscopy on every piece of economic news that comes out. It feels like the reports that are coming out are somehow trying to sell a bill of goods rather than just provide the information for the markets to absorb. This is your market rate update. December 6th, 2022. Let's dig in. So Friday, the jobs report comes out. That Friday's jobs report sounded awesome for jobs. Gains 263,000, well above projections. Manufacturing gains 14,000, 20,000 in construction. Here's the crazy part. Rates had a knee-jerk reaction and got worse based upon this news. Remember, I've said it here many times, good news for one sector does not always mean good news for mortgage rates and vice versa, right? So why did rates get worse? Well, with such awesome job numbers, it means the slowdown is not working and that inflation perhaps is not under control as much as the higher ups may think. So the market reacts and thinks this is bad for mortgage-backed securities and bad for rates. So Friday, we see much of the previous gain traction on lower rates disappear in the morning. Then the market's BS meter kind of goes off, right? They start comparing the BLS jobs report, let's call it the BS jobs report, to the ADP jobs report, which came out earlier in the week. So the BS jobs report calls for 263,000 gains. That's what it was saying we were at. But ADP says there's only 127,000. BS jobs report says 14,000 gain in manufacturing, but ADP is saying 100K lost. 20K gain from the jobs report. ADP says there was a couple thousand loss in construction. So which is more accurate, the jobs report on Friday, or that jobs report, by the way, uses modeling and surveys about 1 in 2,000 people, or the ADP report, which has real data on about 1/5 of employees in the country? The bottom line, there's starting to be a lack of trust in numbers, in my opinion. The markets are reacting to things like they wouldn't in the past, assuming integrity of the figures. And it's only after knee-jerk reactions that they calm and rest in a place of stability. So Friday, we saw a swing of rates up and down over 1/4%. Today, we're settling back in, but expect more rocky roads ahead. The good news is that rates are down in the past 25 days significantly, almost 1% on most products, not all. And the forecast is still for them to drop in the first quarter of 2023. So fingers crossed, our days ahead are a little more predictable and stable rather than bumpy like they have been, but I don't know if I'd bet on it. More news to come Thursday. We'll see you then.